In Chapter 10, we will learn how to estimate the projected cash flow for the project, and then we will use the measures we learned from Chapter 9 to decide whether to accept or reject the project. Let's first to start with a relatively simple example. This is the example in the slides, the shark attractant project. In the Excel, we are giving all the basic information for this project. We expect we can sell 50,000 cans of this per year. The price is $4. Variable cost per can is $2.5. Required return for this project or firm is 20%. Fixed costs per year is $17,430. The equipment investment is $90,000. We expect this project to have 3 years, and the initial net working capital requirement is $20,000. The tax rate is 21%. This is the conditions for this project. First, we will prepare a pro forma income statement to estimate the sales, cost, and EBIT tax for this project. Basically, a simplified income statement for this project. First, the sales for the project should be the unit sold times price. Let me show the formula here. When I show the formula instead of the sale numbers, we can see there is a name for this for the above basic inputs. The reason is in Excel, you can name instead of the sale numbers, you can name the sales to better understand the relation between the formulas and the sales. Second, the variable cost for this project should be the unit sold times the variable cost per can. Fixed costs every year. The depreciation. In this example, we are giving that it's the straight line depreciation. That means each year, the depreciation expense will be the same. In the Excel, we are giving a depreciation function for the straight line depreciation. It's called S. For S, all we need to enter is the cost for the equipment, 90,000 for this question. Salvage value, we don't have salvage value in this example. We leave it blank. The life for this project is 3. The depreciation each year is 30,000. EBIT for this project every year should be the revenue minus variable cost minus fixed cost minus depreciation. We can get EBIT for this project. The tax expense should be the EBIT times tax rate is 21%. The net income should be EBIT minus taxes is 21,780. That's the pro forma income statement for this project. A little different from the income of the firm, we need to notice that the depreciation is not real cash flow. To calculate the operating cash flow for this project, we should add it back. The only reason we include the depreciation here is because it can reduce the tax expenses. Okay? It can reduce the taxable income. When we calculate tax, we need to consider the depreciation. After we calculate the tax, we need to add it back. Here, the EBIT we calculated, and the depreciation each year we also calculated. Tax we have also calculated here is 5,000. The operation cash flow for this project should be EBIT plus depreciation, and then minus the tax we need to pay. This is the operating cash flow for this project. We included depreciation in our calculation twice. The first time we included because we need to calculate the taxable income. The depreciation, although it's not a real cash flow, but regarding accounting calculation, it will influence the tax expenses. We have to include it before tax. After we calculate the tax payment, we need to add it back because it's not a real cash flow. After we calculate the operating cash flow, we can start to establish a projected cash flow for this project. Every year, for this project, we have the same operating cash flow. We add dollar signs. Change in net working capital. In this example, we have a initial net working capital. Net working capital is 20,000, which the investment at the beginning, and we expect to recover this investment at the last year of our project. The capital spending of the equipment is 90,000 at the beginning. The total projected cash flow for this project should be sum of the three types of cash flow. Okay, operating cash flow, net working capital, and capital spending. Based on the projected cash flow, we can calculate the NPV. We use the required return for this project is 20%. And remember to select from cash flow 1 to 3 and then plus the initial investment. The IRR, we select all the cash flow here. The last, we estimate the payback period for this project. First, we need to calculate the cumulative cash flow. In year 0 is equal to the total cash flow. In year 1 will be previous year's cumulative cash flow plus the cash inflow in the first year. Then we select it to year 3. This is the cumulative cash flow for this project. And based on the cumulative cash flow, we apply percent rent function. We select all the cumulative cash flow and trying to figure out where is the value of 0. Then times the total years of the project 3, we got the payback period for this project is about 2.9 years.